Welcome to Next Round with the Pacific Research Institute. I'm your host, Rowena Itchon. In this podcast, Tim Anaya, PRI's Director of Communications, and I chat with Wayne Winegarden, PRI Senior Fellow in Business and Economics. PRI recently published Wayne's study on the impact of the state and local tax deduction cap on high-tax states such as California. The deduction was capped at $10,000 in 2017, which meant that many California homeowners and those who pay high state taxes had a bigger tax bill this past April. In this study, Wayne looked at the short and long-term consequences of the SALT cap on California and other high-tax states. Thanks for joining us. Wayne, welcome once again to PRI's Next Round podcast.
Well, thanks. Great to always be here.
So you've just released a new study on the impact of capping the state and local tax deduction, also known as the SALT cap, as part of the Federal Tax Cuts and Jobs Act passed in 2017. Before we discuss the findings of the study, refresh our memories by giving some background on the law.
Oh, absolutely. The tax code is full of all sorts of deductions, some of which are warranted, many of which aren't. And the state and local tax deduction is actually one of those unwarranted tax breaks. It's actually been part of the tax code ever since it was actually first implemented. So it does have a long history. And the idea was that if you've paid taxes to your state or local government, that those taxes that you've paid shouldn't be considered part of your income for when you're making your tax payments to the federal government. It was supposedly to kind of preserve the state and local tax base. It really doesn't work that way. It really, economically, there's very little justification for it, but that's what the tax code has been. So in 2017, Congress just simply, they put a cap on the value and they said $10,000. That's the value of the deduction. All tax filers, single, married, filing jointly, does not matter. You can write off $10,000 in state and local property, income, and it's either income or sales taxes. And that's it. So it creates that hard cap on that state and local tax deduction.
So let's start with the big picture. And this was actually a discussion that we had enjoying some wonderful Mexican food in Austin, Texas for a conference recently. Many feared that SALT would actually bring a collapse to the housing market in high-tax, high-priced housing states like California. Yet we haven't really seen that. So why do you think this didn't happen?
Well, this is just such an important question. Right now, property markets are intimately kind of intertwined with our tax code. And so obviously one of the tax deductions you can write off of your local property taxes. And the theory or the fear was that, well, if people can't write off the state and local taxes off of their federal taxes, then what's going to happen is the cost of home ownership will be higher. And if you have a higher cost, your demand is going to be less. And then, of course, the value of homes are going to fall. And that really, it didn't happen, I think, for a number of reasons. One, especially with respect to the state and local taxes, I don't think that effect is particularly strong. Additionally, when you have the deductibility of your property taxes, that's actually reflected in the rents. When you pay rent to a landlord, their costs are going to include the state and local taxes. So whether or not you're really changing that relative price of home ownership versus renting, that's also questionable. But I think perhaps most importantly, the SALT cap is at $10,000. And so for most taxpayers, except for the super duper rich, right? For most taxpayers, $10,000 is more than enough so that they're writing off the full value of their property taxes. So if you're writing off the full value of your property taxes, then the cap is meaningless. So you haven't really changed anything. And certainly for the kind of the starter homes and for the kind of average home, you're not impacting it at those markets. And that's the majority of your housing market. Having said all of that, there is some evidence that at the upper end of the market, which is where you would expect these effects to be happening, that there actually is a bit of a redistributional impact where high tax states like California and New York continue to lose out to low tax states like Texas and Florida. And so you are seeing some certainly anecdotal evidence where New Yorkers are having an incentive to move to Florida, and that's been increased because of the cap. But that is more of a state and local policy issue, not really from the SALT cap itself.
In your study, you make the case that before the $10,000 cap was put in place, the state and local tax deduction encouraged states like California and New York to increase their state budgets and increase tax burdens. What was this incentive?
It's simple, right? But like I just said, when you increase the cost of something, you're going to expect less of that activity. And when you decrease the cost of something, you should expect more of that activity. This is really economics 101, taught at every high school class, let alone component in colleges. So what the state and local tax deduction did is, in effect, had the federal government subsidizing, let's say, 30% average or 25, whatever the number was, cents on the dollar. So for every dollar effectively that California would tax its residents, the federal government was effectively picking up 25 cents of those costs, right? Because my federal tax burden went down by that 25 cents, 20 cents, whatever was the appropriate rate. And so when you effectively lowered the cost to a taxpayer, I don't necessarily care what my tax burden between the federal and state governments are going to be as much as that total tax burden. And so when you've lowered that cost, I'm not going to respond as much. The economic incentives to change my activity aren't as strong. So that allows the state and local politicians to spend a bit more of the money. I think if I can, a great analogy is you have a young adult just stepping out into the world, and then they still use their parents' credit card. And so when access to the parents' credit card, they're going to spend a little bit more than they otherwise would, may go to a few more clubs, go on an extra trip, buy a little bit more expensive food because those costs are subsidized. If you pull the credit card, now all of those costs fall directly on them. And so now you have to actually fully, your actions, you're going to fully bear those costs. And so effectively, when we're capping the state and local tax deduction, that's what we're doing.
You also make the case that taxpayers in low-tax states like Indiana actually paid a higher tax burden and effectively subsidized the higher taxes and spending in states like California and New York. So how is it that Indiana taxpayers were making it rain in California? And how was the SALT cap a better deal for taxpayers in these low-tax states?
That is such an important question. And I think, often they say in economics, the importance is to bring out both the seen and the unseen. And this is really the unseen part of why that SALT deduction is so damaging. It's because when you have that SALT deduction in there, you're not effectively changing incentives across the entire economy, but also you're not controlling spending, right? And Milton Friedman, I think, said it best, which is government spending is government taxation. So if the SALT cap is not controlling spending at the federal level, then that lost revenue from the SALT cap is being picked up either through higher debt costs that all taxpayers are bearing or through tax rates that are higher than necessary on all federal taxpayers. And so if you're a low tax state, you're getting less of a kind of benefit from the state and local tax deduction you get to claim, but you're paying that higher cost that everyone has to pay because we're giving an extra, really an unwarranted benefit to effectively the high income taxpayers from high tax states. So because, like we had said earlier, if I'm getting a 25 cent on the dollar subsidy to California for that state spending, somebody else is picking up that cost. It could have been picked up through effective spending control, but we can certainly, the evidence shows that we haven't had any of that, and there's no relationship between the size of the SALT break and how much the federal government is spending. So that cost is picked up by low tax state taxpayers of all income levels.
You argue that the reforms in the Tax Cuts and Jobs Act were a better deal for many taxpayers in every state because it brought about broad-based tax relief. Why don't you walk us through the math on how you decided that?
Absolutely. And this is incredibly important. In the first place to start, we don't go too much into this in the paper, but I think it can't be underemphasized. Most lower income taxpayers, if they are paying income taxes at all, do not itemize on the tax returns. So in other words, they just take the standard deduction. And so all of these fancy tax breaks for state and local taxes, interest, charitable deductions, is irrelevant for them, right? So anyone who's in a lower income, they're not benefiting from that SALT deduction at all. So when we lowered rates across the board, that's just a net benefit for them. So when you want to look at kind of how does this net out, you're really looking at certainly at best average income and above, right? Because that's where people might start itemizing their taxes and their returns. So before the tax break, we kind of just walk through. You had let's take $100,000 income as the example, and the actual benefits to Californians expand as your income goes up. Prior to the Tax Reform Act in 2017, if you were $100,000, you were probably in the 28% marginal tax bracket. Even though you were at a 28% marginal tax bracket, bracket, because of the SALT cap, because of the higher California taxes that you were paying, if you lived in California, your average tax rate was 15.5%. But if you lived in Indiana, your average tax rate was 15.7%. So you were paying slightly more, about $200 more to the federal government, having the exact same adjusted gross income, kind of exact same tax situation, if you lived in Indiana compared to California, because California taxed more. Now, of course, Californians overall had a higher tax burden, but that was imposed by the state and local government. And that really, if you live in Indiana, that's not of concern to you. So you had a higher tax rate on average, even though you were in the same marginal tax bracket and the same income prior to 2017. After the tax reform, right, if you had that same $100,000 income, you dropped from the 28% bracket to the 24% bracket. But what you saw is that the difference in terms of your average tax rate got closer, so that as opposed to 15.5, you had a 12.8% tax break. Whereas in Indiana, you would have a closer, just about a little under 13%. So that difference narrowed, and the more kind of income you had, the more that income differential came closer together. And in fact, for high income taxpayers, the average tax rate would become the same. So $500,000 and above, you would each be paying an average tax rate of 24%. So what you've effectively done is taken away that kind of extra benefit that the higher state and local taxes were giving California or New York, Illinois taxpayers when it came to paying their federal taxes. And again, one definition of equity, an important one, is you treat similar taxpayers similarly. If I make the same income as somebody else, right, and I have the same overall deductions, except for, let's just say, state and local taxes, it really seems inequitable that I have to pay more taxes if I live in a lower tax state than someone who lives in a higher tax state.
So here in California, Democrats running for Congress in the last election used the SALT deduction cap as an issue with which to successfully hammer a Republican candidate. And they charged that the then GOP members of Congress who voted for the SALT deduction cap voted to raise their constituents' tax burden. Well, looking at the finding of your studies, it would appear that we would award them 4 Pinocchios if we were the fact checker for the Washington Post. So settle this debate. Did the tax burden of these Californians go up? And if so, who is responsible for increasing their tax burden?
If you're in the highest income, your tax burden went up, right? Everyone else, they saw a reduction in the tax burden. But if you're in the highest income brackets, your tax burden did go up from the reform. That's, I think there's no doubt about that. But I think it's very important to differentiate between somebody imposing a cost, or the federal government imposing a cost on someone, versus the elimination of a benefit, especially an unwarranted benefit. And I think that's the important distinction. If I've lost a benefit, someone who was giving me something, and they're no longer giving it, that's not the same thing as a federal government imposing a cost. What they have been doing is underwriting the excessive costs of California's high tax and high spending programs. And there is no justification for why taxpayers in Indiana, Virginia, Alaska, Texas, for those taxpayers to be underwriting the costs of California state government. If Californians want a high tax, high spending state, and that's what they decide to do, I would think that's economically unwise, but that's their choice. They should bear the full consequences. I think, though, the outcry that we're seeing and the almost the acceleration in people considering leaving California is a strong indication that, in fact, people, when it comes to their actual preferences, don't prefer high taxes, don't prefer high spending. And so when we're removing that subsidy, when we're removing that force that's been kind of diminishing the effects, people are realizing, hey, this is too expensive. To go back to our current analogy, we'll pull in the credit card from the young adult. And now they're saying, okay, how much should I really be spending? And they're realizing that they were spending too much. And that actually is going to not only help California have a more competitive tax system and a more competitive economy, it will also then have reverberations that will have benefits across the country.
So Wayne, you argue in your study that one of the reasons why taxpayers in these California districts were so upset is that they are finally feeling for the first time how much they're paying in state and local taxes thanks to the SALT cap. What's your advice to those taxpayers who are not happy with the expensive state burdens imposed on them by their governors and state lawmakers, and those of us who'd rather stay in California than leave, so we want to fight rather than leave? So what would your advice be to us?
Fight. I think we need to contact our state legislators, contact the governors. But I guess, take the opportunity, right? Turn lemons into lemonade, right? We have a very uncompetitive tax system in California. One of the things that Arthur Laffer and I wrote in our book Eureka, talking about fixing California, is there's a lot of better tax systems out there. We recommend a flat tax, and I think that has a lot of value to it. But certainly, smaller reforms that start to improve the incentives and the pro-growth aspects of California's tax system and California's spending obligations are out there. And this hopefully creates more of an impetus to actually have a rational conversation about how much California should spend, and I think just as importantly, on what should that spending, how should that spending be allocated? And so if we take kind of these lemons and turn it into lemonade, can we get a more pro-growth, fairer, simpler tax system? Because since we've taken away that kind of blunting force on those costs, we realize those costs are too much. California, literally, from a geographic and environmental benefit, California is the best state in the country. I mean, there's no place more beautiful than California, and it should constantly be that draw, that the pedestal of the American dream. And if we fix the tax system, some of these outflows can be reversed.
Senate Minority Leader Chuck Schumer recently had a press conference in a neighborhood in White Plains, New York, where he decried what he called the nation's highest property taxes. But then he blamed Congress for making it worse by imposing the SALT cap. Schumer and lawmakers from these high tax states have introduced several measures to try and reverse all or part of the SALT cap. What would the impact of these measures be if they were passed into law?
Well, I would love to get the tape of Senator Schumer on the Senate floor arguing for lower taxes. I think that would just be priceless to have that on YouTube. I guess, in all seriousness, the most important thing is this was a movement in the right direction, right? We through the tax reform, and it wasn't the best, right? There are flaws in what was done, and certainly the fact that it's sunsetting is disappointing, and we're going to have to go through all these issues very soon. But we had a pro-growth reform that lowered rates and broadened the tax base, and that's where we need to keep working, keep pushing the federal tax code. That same principle that California should be pursuing doesn't change simply because it's at the federal level, not the state level. And so if these measures passed, we would be going back to where low tax states are subsidizing high tax states. Low tax states would have an incentive to spend more because, why should I let, if I'm Indiana, why should I let Californians get all the benefit of that federal tax deduction? Why should we be underwriting their costs? They should underwrite our costs too. And you do that by spending more and taxing more. So you have that constant incentive for higher than optimal state and local government spending and state and local government taxes. We would be reinserting that if we kind of had these measures that reversed all or part of the SALT cap, and that would move us backwards in terms of tax reform. And at the federal level, what it would also do, we now have $1 trillion deficits because we still have not controlled spending, and that is actually the most important fiscal issue going forward: is getting federal spending under control, ideally for the long term. And this takes us in the wrong direction because we're not improving incentives in the economy. We're just giving out another special interest tax break. And that's not how we want to be pushing tax reform, and that's not helping control that number one problem of excessive federal spending.
Wayne, to wrap up, enacting an ideal economic policy to fuel strong, sustained economic growth is something that you've studied and written about extensively, especially in your Beyond the New Normal series. So how would you rate the SALT cap and some of the other provisions of the Tax Cuts and Jobs Act toward achieving these ideal tax and spending policies to maximize economic growth in the U.S.?
I think they've been important in terms of pushing us towards a better tax system, right? I mean, most important at the corporate level, we brought our corporate marginal tax rates in line with the international tax codes, certainly moving away from that global space. All of that has improved the economic incentives on the corporate tax side. It's made a flatter tax, which again is more pro-growth, simpler, costs less to comply with. That's all to the benefit. We did some of that at the personal side, and so that was helpful. And the SALT cap was really part of that essential process of we want to broad-based or a broad tax base with a low tax rate. And we've helped achieve that, and we don't want to lose it. So I think the TJCAA, it was a beneficial tax reform, pushing us closer to the ideal. And so we want to build on that, fix its flaws, make it permanent, keep expanding the base, keep simplifying it, the tax code. That's how we should be kind of looking at our next steps with respect to taxes. And again, going back to the spending side, we've got to start bringing the entitlement spending under control. We have to start bringing some of this discretionary spending under control, start looking at caps to spending so we can let the economy and people's incomes begin to grow faster in the federal government as opposed to the other way around. And that's how we can help ensure we have a stronger economy that can afford all of these entitlement spending that we're going to have in the future because of the retiring baby boomers. And so in that broad sense, the TCJA was a step in the right direction. I would disappointed that we haven't gotten the spending control to offset that.
Thanks so much, Wayne.
Thanks again.
Special thanks to our guests Wayne Winegarden and to Tim Anaya. You can read PRI's study on the SALT deduction cap at pacificresearch.org. If you like this episode, please tell your friends and subscribe to PRI's podcast at iTunes, Google Play, Stitcher, or TuneIn. And please do us a favor and give us 5 stars. You can also listen to our podcast on PRI's YouTube page, youtube.com/PacificResearch1. That's the number 1. Thanks for listening. I'm Rowena Itchon. We hope you'll come back again for next round with PRI.